All right. Good evening, everybody. How you doing? Please let me know if you can hear me. Okay, everything should be okay on my side. How's everyone's week been? We're just going to jump on really quickly. Hopefully, take some questions from you guys, and I will be sharing my screen through some of this as well, just so that you guys are fully aware. Just make sure that that's actually working as well. Perfect. All right. Okay. Let's see what we got in the chat already. How you doing, Naim? Hope you're well, mate. Food Dweller, how you doing? Jal, thanks for being here. I'm really, really good, mate. Thank you very much. Yeah, it's been a busy week, so and prepping for next week already. Shola, how are you? GT Playboy, welcome everyone. All right, okay, so um, bear me 1 second. 1 second. Okay, that's better. All right. Right, so let's have a look and see what we got here. Carly, I can see that you're here. How you doing? Mercy, welcome. Right, there is one question on here already from Joel. So let's get into this. Going to give this a solid hour or so. Right, if inflation persists, is a gilt index fund slash ETF a guaranteed way to keep pace with inflation and therefore better than cash with the current low interest rates? I need this pot of money within 4 years. Um, it's not a guaranteed way to keep up with inflation, but it will definitely do. It should do better than cash. Let's put it that way. Because in your savings account, you're probably getting what 0.2% in cash right now. You should get better than that in a bond ETF or a bond index fund for sure. You should definitely get more than that. So it's not a surefire guaranteed way to beat inflation, but it will be better than cash, and it will provide some level of hedge against inflation for sure, so that you can at least keep up with what's going on. But by no means an absolute guarantee that you're going to beat inflation um, number by number. I mean, you've got to remember inflation numbers are pretty high right now. They are really, really high compared to where they should be at 2%. If inflation was around about 2%, then you could argue, well, actually, you should be fine within a gilt index fund or a bond ETF of some kind. But with inflation being at about what 5.3, something like that, yeah, you may get to that level. It depends on what you choose and what the performance of it is, and depending on who you're basically using. But it may not. There's no surefire guarantee that it's going to beat inflation directly. All right. Okay. Have I read any good personal finance books lately? No, I haven't. But I do have two books at the minute which I've got in front of me. I've got this one, which is obviously the popular one, Chimp Paradox. And then I've got this one as well, which is the Purpose Cycle, which I'm going to be digging into this week, essentially. I've actually got a box of these down here that I need to give away as well. So this is going to be one. This is personal development. I actually spoke about this on Instagram during the week. So this will be my next read. I've already read the Chimp Paradox before, but I'm just going back over it again, just doing obviously research for my own book in terms of how things are actually structured within books, in terms of trying to convey points and stuff. To be honest, I'm not a massive reader. I'm very, very much a visual person, so I love kind of like documentaries and stuff. So I do a lot of documentaries and stuff. But when it comes to books, I will pick up the odd book here and there. I've got a few books behind me here, and I've got books upstairs as well. But I've not read any great personal finance books lately, personally. Good man, Simon. Good man. You're here now. So if you do have any questions, by all means, pop them in here. Do you do portfolio reviews? 1 second. This is the right question. Do you do actually? Where is it? 1 second, guys. Shola. Okay. Do you do portfolio reviews? Let me know what you mean by that. Portfolio reviews in terms of individual portfolio reviews. I can do those with in coaching. Yes, I can have a look and see what you've got, then try and make sense of it versus your goals, your timeline, your risk appetite, that kind of stuff, and kind of give you a steer as to whether you're taking less risk and should be taking more, whether you've overstepped on the risk barrier, if that's what you mean. Um, but let me know, mate. Let me know if that's what you meant. Question here: what do I think about oil prices today? To be honest, I've not noticed oil prices today at all. What's going on? I would imagine they gone up. I've not kept up to date with it, so I can't say that I can give you a really nuanced view on it because I've not really been tracking oil prices at all. Um, yeah, sorry, Leah. Views on XRP. Well, look, XRP. I used to hold XRP. I think I've still got a little somewhere in a wallet somewhere. I need to tidy up my crypto. Really, to be honest, I've been saying this for a very very long time. I've kind of congregated them into like maybe one or two accounts right now. But XRP is a funny one. I mean, look, the lawsuit in the states has been a big kind of like point for it. I know that there's been some developments around. Government cryptocurrencies where they're apparently there will be adopting some of the stuff that XRP is using. I think that's good news. Beyond that, mate, I can't say that I've tracked XRP because everyone seems to be saying that it's going to get to $4 or something like that within a very very short period of time. Then it never happens, and I've just kind of like I've got it, but I kind of just left it as it is. I don't know what the outlook is for it. I need to get Ralik on, who's kind of like more into crypto than I am, to give a bit of a view. He's been in South Africa, so hopefully I'll get him on maybe in the next week or two or so onto a live Q&A where we can talk crypto specifically. I think Bitcoin at the moment it's kicking everybody's ass. It's down really really low. I'm personally thinking about throwing quite a bit into Bitcoin because we haven't seen it come this low for a very 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 long time. So potentially looking to go in there. But yeah, XRP, I hold it, but not really keeping an eye on it, to be honest. This is a good question. Right, bear me 1 second. What's going on here? I keep pinning comments. Right, here we go. Right, so GD Playboy's asking this question. So, are 95% mortgages sensible for first-time buyers? This is a really good question. So it really depends on your circumstances, basically. Okay, and this is where you need to start thinking about the practicalities of how mortgages work and the practicalities from your own personal financial position as well. And I think maybe what I'll do is I'll illustrate this a little bit so that you guys can kind of make sense of where my train of thought basically goes with this. Okay, so bear with me 1 second while I'm trying to get this to basically work. Okay, so think of it this way: you're going for a mortgage, right? And I'm just going to keep the numbers fairly simple and fairly high level. So let's just say you are looking for a mortgage and you need a property is worth £100,000. This is the property value, right? Right. So a 95% mortgage will basically mean that you're borrowing £95,000. Now, from a mortgage lender's point of view, you need to think about risk because, sorry, you need to think about risk. So when you go to a mortgage lender, the thing that they're thinking about most is risk. Okay, so what does this mortgage contract represent in terms of risk to me? Now, the risk to them is, well, you've only put a 5% deposit in, so therefore you owe more, yeah, which means that if you owe more, anything would happen around, you lose your job, COVID happens again, furlough, they are in the hole potentially for more money and they're carrying bigger risk because you owe £95,000 and took a 95% mortgage. So what they're going to do immediately is to offset that risk. So what they do then is they will place a mortgage rate that they feel is approximate to the risk that they're taking of a 95% mortgage. This is how the mortgage lender is going to be looking at it. So they're looking at the risk and then they're assigning a rate to it, which is why you'll typically find that when you go for a 95% mortgage, if you go for one like that, the mortgage rate is typically higher than if you went for a 75% loan to value mortgage, right? So you had a 25% deposit, or even if you had a 20% deposit, the rate here is going to be higher because it represents higher risk. Now, from your point of view, a couple of things that are worthwhile kind of looking at is, right, okay, so you have a 5K deposit that you put in, but you owe £95,000. Now, with a mortgage, clearly, a mortgage is typically a long-term contract, meaning that the typical mortgage is probably between 25 to 30 years on average. You have some of them will go up to 35, some of them, but this is the average, 25 to 30 years. So £95,000 over that period of time means that essentially, because you're stretching out over longer, you are paying more interest. Yeah. And when you combine that with a higher mortgage rate, effectively it can potentially cost you more. Now, clearly, if you're taking out a 95% mortgage, you're probably going to go into a 5-year fixed rate, maybe, for example, if you don't go for something like the new Habito mortgage, for example, where you're locking in for much, much longer to protect yourself against interest rate rises. So you may be able to rebroker. But from your point of view, the biggest concern is going to be you are borrowing 95% loan to value. You're going to be paying a higher mortgage rate. So what does that translate to into monthly payments? This is the bigger question. And when you're planning and trying to decide whether you should go for something like a 95% mortgage, you need to be very, very mindful of whether or not you can afford the monthly payments on a 95% loan to value mortgage, particularly if you do see interest rates rise. And whether, regardless of whether you're in a 2-year fixed, 3-year fixed, 4-year fixed, or 5-year fixed, that increase in interest rates could mean that this also increases as well. Really, really important. As long as you do the maths and you crunch do the calculations and you look at your personal finances, and don't do it from a place where you're excited about getting on the property ladder, because that can often cloud your decision making. You need to be very, very pragmatic. What we often try to do, and you'll go through things like affordability tests with the mortgage lender. This is often the killer, yeah, because on the affordability test with the mortgage lenders, when they do this, they ask you whether you've got things like credit cards, overdrafts, personal loans, car finance. If you have any of these, it will reduce your ability to borrow this amount right here. Because essentially what they're trying to do is they're trying to stress test you to lower the chances that you might default on the original loan. And from a personal point of view, when you're applying for a mortgage, you really, really do need to consider those things. If you've got overdrafts, personal loans, car finance, credit cards, those kind of things are going to be a drain on your income, which means that if your interest rates were to increase after 2 or 3 years of being on a fixed rate, can you still afford your mortgage? Because guess what? If you haven't been structured around things like your credit cards, you're still probably going to hold that debt, paying interest if you're paying interest or paying minimum payments. Your personal loan might still be there. Your car finance might still be there. So you have to be very, very structured. And God forbid you're on an overdraft that might be charging you something like 39.99% on your annual rate. So these things are very, very important when looking at this equation of can you actually afford to take a 95% mortgage, because you have to think beyond the immediacy of getting the mortgage and getting on the property ladder to how can you afford it from a long-term point of view. There's another thing as well that often people don't tend to realize about 95% mortgages is if you are, say, in a couple. So let's just say it's one second. Let's just say it's him and her, right? Okay. So most couples, when they buy a property, that oftentimes will signal that there may be a baby, you might be planning for a child when you move in. So imagine you've taken a 95% to 95% mortgage, right? And then within the first maybe 3 to 5 years, a baby comes along. Now you would have taken out the mortgage, I would imagine, on combined income But what happens when baby arrives, then maybe misses, or you, or maybe the man decides we need to swap and maybe cut down some hours, and then you see income half because of baby duties. Really, really key thing. You have to look at it pragmatically based on your scenario, based on what's going on for you when you're approaching this kind of stuff. I would always generally say that if you can afford to, just wait it out and try and get maybe a 10% mortgage, so a 10% deposit, try and do that if you can. It's not always possible, granted, I 100% get that. But if you're able to do that, by all means, try to see if you can actually get it in with a with a bigger deposit if you can. Sorry, I'm just trying to fix this. There we go. If you can, try and save for a bigger deposit. And I know that is harder than it's harder than just saying go and find a bigger deposit. The reality is we're in an environment right now where house prices are just going nuts, wages are stagnant, savings and interest rates are so low. It's difficult. It really, really is. But if you can be structured to get a bigger deposit, I would generally say try and do that. Use a 95% mortgage as a very, 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 very last resort if you can. If you can get help from people as well, by all means, get help from people if you've got family that are willing to step in and help with the deposit too. Hopefully that helps. Now, where was I? Would I recommend The Richest Man in Babylon? Yes, that's a really good book. So there's a principle in the Richest Man in Babylon, which is kind of like a continual theme. He talks about, if you want to be wealthy, try to basically ensure that you're saving 10% of what you earn, right? Really, really good concept. And I was having this conversation with somebody. Actually, we spoke about this on the Pension Bee podcast, which I'm hosting now, in episode 1. If you haven't listened to it, guys, you definitely go and listen to it. It's in all of the good app stores at the moment. It's called the Pension Confident Podcast. We talked about the fact that actually you talk about 10% of what you earn. Those numbers are immediately there within your pension. You can do that within your pension straight off the bat because your employer pays in 3%, you pay in 5%. If you're able to maybe pay in, I don't know, the difference, another 2% on top, all of a sudden 10% of what you earn is already going in. And that is the formula, one of the formulas that is a recurring theme in Richest Man in Babylon. So it's a great book. I think with books, it's all about how do you actually practically apply that to your day-to-day living. Some people will think, well, 10% is quite a lot. How do you go about doing that when you've got bills to pay? But a pension is an easy way for you to begin, particularly if you've got an employee who will match your contributions. So if you got to 6, for example, and they match you at 6, all of a sudden you're over that 10% in that book. You're now at 12%, which means you're really building for the future. So yeah, really good book. Principles are great as well. I haven't read this one, Psychology of Money. I've not read that one just yet. Naeem, great video you did with Aaron on NFT, so thanks. Now I watched Coin Bureau, a recent video on Web 3.0 talking about its purpose, pros and cons. Just want to hear your thoughts. You know what? I'm actually on the Coin Bureau mailing list. I think I got the email this afternoon, and I haven't watched the video just yet. I understand the premise of Web 3.0. It's more about ownership, isn't it? So, for example, me as a creator, in opposed to people just browsing the internet and the internet company like Google or Facebook owns the property, it gives me ownership over how my content is consumed, so on and so forth. I think it has a great application and utility, but I don't know enough about it, and I haven't watched that video to be able to give you a proper view. Maybe this is one that we can move on to next week, and I'll watch the video and then formulate some views on it. But Web.3 is one that I'm hearing more and more and more about, and it sounds really, really interesting in terms of this is going to be the next phase of the internet, and it is, from what I understand, going to amalgamate with the likes of the metaverse, so on and so on, so on and so forth, the blockchain, NFTs, and everything. But yeah, it's really, really exciting. From what people are saying, it's going to be like the internet back in 2000. 2000. People didn't understand it back then, but it's something that we now have come to the point of not really being able to live without. That's going to be the new version of it. But yeah, I need to watch that video just to give you a nuanced answer. Yeah, the Intelligent Investor. I've read parts of it. I've not read the whole thing. It's a really, really good book, though, from what I've read so far. If I would buy a house in 3 to 5 years, would it be smart to invest my savings in index funds now? Good question. Very, very good question. I'm going to illustrate this as well. So I do this. I often have these conversations with people who I do coaching with, basically, because overwhelmingly, a lot of the times when I ask people what their goals are, house purchase is the first thing that they're thinking about. And the way I kind of rationalize and get people to think about this is to essentially try to, number one, keep the eye on the ball, keep your eye on the goal, on the ball, right? The goal here is to acquire the house. It's not necessarily chasing the biggest returns within that period of time, although I know that bigger returns helps you get the house. What I'm trying to say here is effectively don't overextend your risk. And this is where we can start talking about very simple things like timeline, um, and timeline theory, right? So you guys would have seen this before, at least I've explained this before, but you may not have seen it in this format because I haven't been able to illustrate it till now. So you're saying that you want to buy a house within 3 to 5 years. Well, the important thing, mate, is to understand whether it is 3 or 5 years. Because what I'm going to illustrate here will be very, very different depending on whether it is 3 or 5 years. So let's just say it's 3 years, right? So let's just say this is the 3 year mark. You're here right now. So we've got a house that you need to purchase right here. Yeah. So you're clearly trying to save up for your deposit. And let's just say your deposit that you need is 10K, right? Now, what you want to do is you want to invest it in an index fund, which will be invested in the stock market, which the stock market will do something like this, right? Which is fine as long as it's on a upward trajectory. Yeah, it's good news. It's happy days. You're going to have more money that you would have generated in the markets over that course of time to help you get to this goal right here, to help you with the house, right? Now, timeline theory and managing investment risk becomes very, very important in this equation. Purely because if you're investing for 3 years, we don't know what the market is going to do. I've drawn an upward slope here, right? But what happens if, this is year one, year two here? What happens if the market actually does this? Then all of a sudden you're here. Okay? If you're here at year one, then you absolutely need to have a stellar year, a staunch year in year two to recover. Okay? And this is transferable. You could have a good year in year one, you could have a really poor year in year three. What I'm trying to say here is if you're investing for 3 years for a house deposit, your risk of the market going down is so much higher within this very short window of time. And that's why we keep saying that if you're investing for a short time, so a short period of time basically means less risk. Very, very simple. So if you're looking to buy a house in 3 years' time, yes, you can invest in an index fund, but you need to be very, very careful around your selection and how you're going to invest to ensure that you're not overextending your risk. Now, if you are using someone like, I don't know, Vanguard, right? And let's just say you're going to go pick the VUSA, which is the S&P 500, yeah? You got to remember this is a 100% equity fund, which means you're 100% invested in the stock market, albeit the top 500 companies in the world. It is a US based kind of like index, really. So it's whole US economy, biggest 500. Now, statistically, you shouldn't have any issues with this fund. Statistically, you shouldn't, because there's 500 largest companies. But what happens if something that we all can't foresee does happen? What happens if this tanks and you're invested in this and that happens in, say, I don't know, year two? You're here, tank, you're in the S&P 500. You lose a bit of your money. Now you've got 1 year to recover, which you'll probably be panicking at this point, right? You don't want to cash it out here because that's a loss for sure. You don't want, so you've got 1 year to basically get that growth back out. So it's really important to manage the risk. And look, I can't tell you exactly what to do because that will be advising you, but this is something you should definitely bear in mind. The picture becomes very, very different if we are looking at a period of 5 years, because the simple fact is you've got an extra 2 year gap here. So it means that you could probably take a little bit more risk within your approach, but you just need to be mindful. From a practical point of view, this is how I would kind of, what I would urge you to think about. If you are, for example, looking to buy a house in 3 or 5 years' time, based on everything we've just talked about here, and I've just explained here, be pragmatic. Let's just say you are looking to save per month, and I'm just going to make these numbers up, okay? Let's just say for your house deposit, your target is I'm going to save £200 per month, okay? What you might want to do, what you might want to consider is perhaps having, £150 go into an equity or equity fund. Then maybe have a look at £50 going somewhere else that is less risk. In these kind of instances, you can also have a look at the life strategy funds, yeah, within Vanguard. If you're using Vanguard, that is. There are lots of other people that you could use. Obviously, it makes sense for you to, within this period of time, to be looking at lifetime ISAs, because essentially, because you're a first time buyer, you can save £4,000 and you're going to get £1,000 from the government for free. So if your target is £10,000 within a 3 year period, if you are able to save that per year, you're going to be absolutely laughing. But again, these are just rough numbers. That's how I would think about approaching it. That doesn't mean to say that you should do exactly the same thing, but it's definitely something to consider in your approach and taking to this. You don't want to overextend yourself on the risk element if if the goal is to buy a house in 3 or 5 years' time. Although with 5 years you've got a little bit more time, so you might be able to up the risk a little bit. But just be very pragmatic and just be honest with yourself. Keep your eye on the ball. You want to be earning obviously returns to help you with the deposit. But to be honest, mate, by you using like the lifetime ISA, you're getting a 25% return here anyway. So happy days. Really, if I'm completely honest, think of it that way. You're getting a 25% return simply just by using your ISAs. Anything else you can get on top of that from the government or from the investment in the markets is an added bonus. You don't need to overstretch yourself in the markets if you're using your lifetime ISAs. And if you're a couple, then obviously you times that by two. So hopefully that helps a little bit more towards your goal. But without knowing your exact numbers, it will be hard for me to say, right, this is how you would have basically structured it. But it gives you a few things to think about right there. All right, let me just find where I was. 1 second. How much am I coaching? So the coaching varies. I offer two packages. So just a one-off coaching service coaching session, which is 90 minutes. I charge £200 plus VAT because I'm VAT registered. I also have a holistic financial review. But what I encourage people to do is book a discovery call with me first. A discovery call is a free 30-minute session. If it's something where I can just say, look, you don't need coaching, this is what you should do, I'll do that. I'm not in the business of ripping people off. And I don't ask people to block book sessions with me unless absolutely needed. So go and book a discovery call with me, Shola. There should be a link in the description to this because I changed my links over for you to just book a 30-minute session. We can have a little chat and see where you are, and we can go from there. Let's have a look at this. How do you know how to work out how many shares you need to average down? Example: average share price cost is £10, now drops to £2. How many shares do you need to buy to average down that price? Explain that again, mate. Look, 1 second. Let me just read that again. 1 sec. Just make sure I understand what you're trying to say. So share price is 10, it drops down to 2. How many shares do you need to buy to average down that price? I don't know. I'm not too sure what you mean there, mate. Maybe just give me a little bit of an extra explanation in the comments, and I'll circle back to this, mate. And give me a little bit of context as well. Give me a little bit of context behind it too. Oh, food dweller, mate. Don't even get me started. You know what? I was watching the match yesterday, ruined my evening to be fair, because I was working at this desk right now, having a bit of dinner, thinking 2-0, absolutely fantastic. We cannot possibly balls this up. Then what happens? It's just, I don't know whether it's Ranić. Actually, you know what? I am going to blame Ranić because he should have locked down the midfield at that point. Matic was clearly tired. Fred was just absolutely useless, and he did absolutely nothing. There was no point in bringing in someone like freaking Donny van der Beek 2 minutes towards the end of the match. What's he going to do in 2 minutes? I mean, he had a shot off, but like seriously. And then they have the audacity to put out this morning within the United app, 50 appearances for Donny van der Beek, when having played, what, 10 minutes or 29 minutes the entire season, is an absolute joke, mate. But don't get me started with United. I'm supposed to go to be watching United and Brentford on the 19th, which I think is on Wednesday. I'm not hopeful at all. Not with the way Brentford play. If we play the same as we did against Aston Villa for the first, 70 minutes, I think we did really, really well. If we can keep that up, then that's fine. But Brentford are just, yeah, Brentford are a very, very good team, and I'm not confident at all. Plus, we're playing them on their turf as well. So it's going to be a very, very cold evening on Wednesday. If I go all the way down there, we somehow balls it up, lose the match, and then yeah, I'm gonna be stuck in traffic on the way back home as well. So fingers crossed. But yeah, yesterday was an absolute joke. It's unreal. Let's have a look at this. Hey Pete, hope all is well. What's your thoughts on micro pennies, cryptos? Also, which is the best platform to buy commodities, only such as precious metals, gold, and oil? Micro pennies, cryptos. I haven't come across them, so I can't give you an answer on that one. If I'm completely honest, commodities, precious metals, gold, and oil. Uh, Oil. I mean, I would ask. So, if you wanted to buy things like precious metals, I reviewed someone recently where you can actually buy precious metals. Who was it? You can use someone like Bitpanda to buy silver, gold, platinum, and I think they've got palladium on there as well. You can use them. You can't use them for oil. If you want to buy oil, I'll be questioning why you want to buy oil, because most people who will buy oil will buy like oil futures, because you're not buying the oil to store, are you? So what you're basically doing is you're buying oil based on future prices. That will be a trading platform. So I don't know whether you can actually go buy them off IG, but if you are thinking of doing that, mate, that's like a completely different kettle of fish. So I hope you know what you're doing. But immediately, I'm just thinking, um, not when I say IG, I don't mean Instagram, by the way. Um, Let me just find it 1 second. Can you buy oil on IG? You'll be trading if you can. That's for sure. If you can, because you would be buying futures contracts. Hmm. I think you can. I'm gonna have to come back to you on that one. Oil is not something that I definitely don't invest in or hold specifically, because normally you're buying futures, and that's not really what I do. But precious metals, you can use Bitpanda for silver, gold, palladium. Or actually, if you're looking to buy, kind of like ETFs and stuff, you'll be able to find like gold ETFs and so on and so forth as well in most of the other areas. I think eToro, you'll be able to find some in there as well. So it really depends on how you want to buy it. But if you're looking to trade them, then yeah, you would need a proper trading platform, if you were. We're just going to ask about mortgage. In a position to go for a 67% loan to value mortgage in the next year, is there a good number to aim for? Listen, if you're at a 67% loan to value, that's a really, really, really good number, mate. Because at the end of the day, you've got to remember, most people who go for mortgages are actually they go for it at the round about the 90%, but certainly new buyers anyway, new home buyers, they'll look at, typically it's a 90% loan to value. So if you're down to like 67% loan to value, you'll get some really, really good rates at that point. um, so yeah, I mean, that's really, really good news. I mean, I think where you are right now is pretty good, you're perfect where you are, maybe shop around. But if you can, in the next year or so, get to about 65, maybe even 60, you'll get lower rates. And that in the long run is going to be beneficial for you because of what I explained earlier around obviously paying higher mortgage rates over the long term and it costing you more money in interest. So if you can get to about 65, 60, that would be pretty amazing. Is there much difference between the UBS S&P 500 index and the Legal and General US index on the H&L platform? Thanks for putting great content out consistently. Loving the whiteboard sessions. Cheers, mate. So if you have, so there are different variations of the S&P 500 in either index funds or ETFs, right? The biggest difference that you're going to find is that LNG, uh, iShares, which is BlackRock, UBS, Vanguard, they will hold the same companies, but the biggest difference will be that sometimes they will have different weightings of those companies. So what I mean by that is, how can I illustrate this so that it makes sense? Let's try it this way, okay? So let's just say, let's get this one up. There we go. Let's just say that this is your portfolio, right? So this is the S&P 500. Right now, what you might find is you will have like little slithers, right? So I've done this really, really badly. 1 second, guys. Let me just do this properly. Let's go out. Right, start again. So this is your investment. Put that to the side. This is the S&P 500, yeah? I need another color on this. So let's just say this is your investment and you're going to have like sections kind of like a pizza, yeah? So you're going to have different slithers, and each slither is a company that you're invested in, right? So we know what the top 10 companies are typically going to be in this kind of investment. It will be the Teslas, the Amazons, the Googles, that kind of stuff. So let's just say this is Tesla. Let's get another color just to illustrate this properly. Let's just say this is Tesla. Let's just say this is Google. Let's say this is Facebook, Amazon. Let's put Target in there. Let's put Berkshire Hathaway in there. You get the picture, right? Different companies are the slithers, are the portions of that pie, right? Now, clearly there are 509 companies in the S&P 500, so there's going to be a lot of these slithers, right? But essentially, the difference will be you might have Hargreaves Lansdown who will say, right, my top 10 in Tesla, I'm going to put 10%. In Meta, it's going to be, I'm making these numbers up, by the way, guys, 12%. This might be, I don't know, 3%, right? That might be Hargreaves Lansdown approach. Then you might have the likes of, I don't know, Vanguard, who will say, actually, you know what? We're going to put 7% in Tesla. We're going to put 8% here, but we're actually going to go 15% here. The difference will be how they allocate, or in terms of the investment, how it's built in this way, what they allocate in terms of each company. So that will be the main difference. Some people will be more heavily weighted towards a particular company or a particular sector. Others might not. All of those decisions will be informed by research. So the Hargreaves Lansdown team will have their own research. BlackRock will have their own research. The guys at Vanguard will have their own research. They will make the decision of how they weight or allocate money in terms of the percentage weighting in the portfolio based on their research. So that's the fundamental difference that you're going to find if you're seeing S&P from the S&P 500 from BlackRock, Vanguard, Hargreaves Lansdown, Fidelity, UBS. That's generally the main difference that you'll find. Hopefully that makes sense. That's kind of a little bad drawing I did there, to be honest, but hopefully that's clear. Hi, I'm between Vanguard, VWRL, or Global or Cap Index accumulation. Which one would you go for? I'm finding it hard to choose. Thanks. Um, what I would do isn't necessarily what you should do, mate. If I'm honest, so it's hard for me to kind of tell you what you should and should not be doing. But let's do this. 1 second. Give me a sec, guys. All right, if you can, just smash the like button for me. That would be absolutely appreciated. Right, let's go into Vanguard actually, and let's have a look at the difference between the two of them. These are ETFs, and these are global ETFs. So the VWRL, and you've got the all cap. So it's not that one. It is, which one is it? Is it this one? VWRL. So you're looking at the FTSE All World ETF. Let me just get rid of this and just share this other screen. One sec. Let's get rid of that one. I want to get rid of that. Let's go over here. Okay, hopefully you can see this. Let me just expand this so we can get this as big as possible. There we go. All right, okay, so this is the VWRL. Okay, so fundamental differences between the two. Obviously, you're going to be considering cost 0.22%. We'll have a look at the other one in a moment. But this is going to be invested in 3,801 stocks, essentially. So within this, you have got large and mid-cap companies in developed and emerging markets. The fund attempts to track the performance of the index by investing in a representative sample of index securities. Remain fully invested except in extraordinary market, political, or similar conditions. Performance-wise, I might need a different pad for this. What are we doing? Right, bear me 1 second. Let me just add these up. So what is that? That's 84 minus 9.62. 75.25. You divide that by 5, that gives you a 15% average. Okay. So over the last 5 years, on average, this has done just over 15%, 15.05%. Okay. Over the last 5 years, invested in 3,801 stocks across small, large and mid cap companies in developed and emerging markets, essentially. Now, I mean, I always have a look at the portfolio data here because I think it's sometimes really, really useful just to see where you're going to be invested. It's a no-brainer. It's always going to be invested majority in the United States as a global fund because it's the biggest market on the planet. But I think that one of the big things is just to kind of get a sense of it's going to be in tech. Both of them will be heavily invested in tech, just to get an idea of who the top 10 companies are. This list probably won't be different between the two of them at all, if I'm completely honest. I mean, you've got Apple, Microsoft, Amazon, Tesla. These are the companies that you would expect. Facebook, Meta, Nvidia, Taiwan Semiconductors, United Health. That's an interesting one. Actually, it's not often that you see that in the top 10. Okay, so we know 15.5%, 3,801 companies altogether that it's actually invested in. This is across large and mid cap. Majority in the US, majority in the tech sector. So it's 59.9% in the US, and I think it was 24% or so in the tech sector. Let's have a look. 24.5% in tech. So US tech. I've just jotted that down. Right, so let's just go out of this and let's just go and have a look at the global all cap. Are we in the right place? 1 sec. 1 sec. I thought we were in the right place. What's going on? Okay, this one right here. Right, so this is the global all cap. So this one is invested in more companies. So 5,868 stocks altogether. Price ratio is a little bit higher, 0.24. So you're paying 0.2% more. The reason for that will be because it's in more companies, essentially. And from a research point of view with Vanguard, they've probably done a little bit more work because they've had to research more companies fundamentally. So with this one here, you're invested in large, mid, and small caps. Remember, the VWRL did not have any small cap companies within there. So this is going to give you exposure to small cap. That presents a risk and an opportunity. So potentially, you might have the ability to get potential growth from the small cap sector in this fund, which will be representative of why there are more stocks in it than the VWRL. So that presents a potential opportunity. Now, what I would look at is and try and understand, okay, so you've got exposure to small cap here. What does it actually do for the performance numbers? Do we see it reflected in the performance numbers in any way, shape, or form? So when we go down to the performance numbers here, well, there aren't any because this is less than 12 months old. We don't know. So essentially, if you're looking at this, it's kind of a leap of faith, really, to be completely honest, because we don't know what the past performance numbers are. We know that they're saying in here, if you're just looking at, and I will always read this, by the way, and you may not understand necessarily what all of this basically means, but it's worthwhile getting to grips with maybe some of the language. Some of the things that I'm seeing here is I'm seeing ESG. So this is basically saying that this is an ethical investment vehicle, essentially. So, and you can see that in some of the language that you're seeing right here. So let me just find the top of this paragraph. Actually starts right at the top here. So this index excludes shares of companies that the FTSE Russell, as both the sponsor of the index and the data source, determines to be engaged or involved in and or derive revenue above a threshold specified by the index provider from the following activities: controversies, i.e., companies which do not meet the labor, human rights, environmental, and anti-corruption standards as defined by the United Nations Global Compact principles; non-renewable energy. So what they're basically saying here is there are certain screens, certain things that they will not invest in. Now, as an investor, this may tick your box big time. There are a lot of people who want to invest ethically. So for some people, they would rather invest in this and know that their money is doing good for the world. Some people just don't care. Some people just want to have a better return. There's nothing wrong with being either of those camps. But this is a consideration because they will have screenings. That doesn't mean that their performance is going to be any worse off. In fact, ethical funds more recently have performed really, really well. Some of them even better. I mean, one of my top performing investments is actually an ethical fund over 2021. So this is a key consideration. You can't see the performance, but let's have a look at the portfolio data here. So we know US, so 64% in the US versus 59.9%. So slightly more exposure to the US. You've got, actually, no, well, the US and Canada. So North America's US and Canada. So 62.2% exclusively in the United States. Okay. You've got the other 2.7% in Canada right here. Now, if we go down to the sectors, where are we invested? 27.3% in tech, whereas the other one was 24.5%. So what this is basically saying is they're invested more in the largest economy in the world, which is the States. They're exposed more to tech, which is where you've seen the engine of growth for markets and funds over the last at least maybe 3 to 5 years. So technically speaking, and whilst past performance is no indication of future performance, you would expect that when you see the numbers for this, number one, they're invested in more companies across large, mid, and small cap. They've got a larger weight into the US. They've got a larger weight into the tech sector. You would expect that they perform better than the VWRL. Unfortunately, we don't know what the numbers are because this fund is essentially brand new. But if I was looking at this, trying to pick which one I would invest in, those would be my key considerations. I can't tell you go and invest in that because that will be wrong for me. But hopefully, I've given you a few things to think about there that will hopefully help you, I guess, narrow down what your choices are. By the way, and I say this all the time to people, you don't have to pick just one of them. If you wanted to, you can pick both within Vanguard. And you could split your money 50-50. You could split it 70-30 if you wanted to. It's completely down to you what you decide to do. But you don't have to pick just one of those funds. If you want to pick both of them and split your money across them accordingly, you can do that as well. That can potentially give you a bit of a hedge because essentially what you'll be doing is you'll be exposing yourself to obviously the benefits of the VWRL mid and large cap, whilst getting a little bit of small cap exposure in the global all cap as well. Not a definitive answer for you, mate, but one I hope that helps give you a bit more clarity and maybe add some food for thought, if you will. Right, let me just find where I am. Bear me one second. Let me just catch up with myself. I just get that on as well. Just get rid of that. One sec. Okay. Now, where was I? Laura, I have a Vanguard S&P 500. Which other ETFs would you recommend? Again, I can't recommend an ETF, but hopefully some of the stuff that I mentioned in that last kind of answer will help you here. Look, I'm a big believer if you are going to be investing, you need to think globally, unless you have an understanding of maybe something coming out of emerging markets or a certain sector or a certain geographical region. I think investing globally just allows you to spread your risk. In I kind of alluded to this in a live midweek, and maybe I can illustrate this as well for you guys, so you can see why I always say this. Is I'm just trying to think how can I actually illustrate this now. So if you're taking a global approach, right? A global approach to investing will basically mean you're investing in different territories. Yeah. So when you think of different territories, you're thinking of the UK, the US, you're talking Europe, you're talking Pacific, you're talking emerging markets. Yeah. Emerging markets. Those are just some of the examples of the territories that you have, right? So a global approach will encapsulate all of this, which means that if something were to happen to the US, you've got more money elsewhere, so you don't really have to worry that much. If something happens to the Pacific, you're not solely reliant on them. If something happens to in the emerging markets, you're not solely reliant on them. It's kind of like eggs and baskets, right? If you have one basket with all of your eggs in it, and you literally drop this basket, you're likely going to lose all of your eggs. But if you have four different baskets where your investment is spread across these and you got your eggs in each and every single one of these, it doesn't matter if you drop one, you've still got four more. And the same principle applies here. It's all about trying to spread your investments across the globe, so that if the US takes a bit of a hit, what we should find is another territory in the world should pick up and benefit as well. The UK is maybe struggling right now. Okay, but does Europe benefit from that? If Europe is struggling, does the UK benefit in some way, shape, or form? So it's a constant seesaw trying to balance your risk. And I think if you're going to be looking for other ETFs that you can invest in, try and look globally. We talk a lot about Vanguard here, obviously, because it is one of the cheapest ones. But the reality is, Vanguard is not the only provider that you can basically use. Hargreaves Lansdown is almost like a supermarket for these index funds and ETFs. You can get UBS, you can get so many. Bill Gidford. There are so many other ETFs and index fund providers that you can access. So do your research, try to understand what it is that you're invested in. But if you can take a global approach, most investment houses that I have worked for start there at the very, very beginning. And then they weight their investments to certain territories based on how they feel, based on their research, the economy and the world markets are going to perform over the next 12 months or quarter or half year. It's all based on research at the end of the day. So I would start global first and foremost if you're looking for an alternative, maybe to the S&P 500 to add on to your investment portfolio. Again, not you should do this, but hopefully something, again, to give you food for thought. Right, let me just clear that. Where am I? Esther. Hello, Pete. I've been paying off my credit card in full each month. My credit score still remains the same. This has been going on for the last few months. How do I increase my credit score? Okay, that's interesting. So your credit score, it updates every 30 days, but sometimes it can lag, by the way. So whatever you do this month probably won't show up this month. It's going to show up the following month. So if you've been paying off your credit card in full for maybe 3 months, you should start to see that benefit come through already. The other thing that maybe I would ask you to have a look at is, have you looked at what else is on your credit report? Because it may not be as simple as your credit card payments being the thing that's lowering your score. For example, I said to someone, kind of, I think it was last year or so, just tidy up, for example, where you've lived on the electoral roll. Because if they have the wrong address, wrong postcode, or wrong house number, that's going to affect you. And it's simple things like that can often make a difference. So on your credit report, have a look through the report. So when I say the report, most people, if they're looking at, using ClearScore or Experian, they look at the number. The number doesn't mean anything. The number is an indication for you to interpret how you're doing. It's just a score out of a number. The number doesn't mean a thing. Yes, you want to increase the number, but the number is derived from an underlying report. So what you need to do, and if you're with Experian, I think you're allowed one per year for free. Right off to Experian or Equifax or what's the third one? There are three. Uh, TransUnion is the third one. Write off to them and ask for your report. Then have a look at what's on your report. On your report, it will tell you if you have any negative factors that are impacting you. That then gives you something to basically go and work on and go and correct. Okay. Missed payments, late payments is going to show up on all of those things because a lot of them show them differently. But let me just illustrate this so I can tell you what this basically looks like. And this is something that you'll find on ClearScore, right? So, for example, if you've got an MBNA card, yeah, what they will do is they'll have a section for MBNA, and then what they do is they'll have like 2020, 21. I've done this the wrong way around. 19, 18. Then what they'll have is they'll have 12 little circles, right? So if you've had a missed or late payment, one of them will be red. Yeah, one of them will be red, right? So any missed or late payments will show up as red. You don't want any reds really at all. So you need to see this. If you have anything in the most recent history, obviously it's going to impact you more than if it was, all the way back here in 2019. Ideally, you don't want any reds, but you won't know that unless you look at the report. So you need to have a look at the report to see what's actually on there, what your detracting or negative factors are. Then you can work on certain bits. But the work that you have done, paying off your credit card in full, would have helped you. But I would hazard a guess that there's something else on the report that is probably pulling you back a little bit. So you need to investigate that to start with, and hopefully that will give you some positive results. But yeah, simple things like electoral roll, make sure you get that right. If you're not on the electoral roll, get registered on the electoral roll. All lenders want to know that they can find you. So you having a track record of where you've lived. They don't want you to be like a nomad, just like hopping here and around everywhere. For them, that's bad news. It means that if they either give you, I don't know, car finance or a credit card, how do they know where to find you? Like me, I live in this address. I'm registered here. I've been here for 6 years. They know if I miss a payment, they know where to find me. They can come directly to me, and that is really, really important. A part of your credit score. So simple things like that can also help. I love this. Financial advice for a 24-year-old. Also, is a pension worth it? Mate, yes, a pension is 100% worth it. I don't care what your mates, I don't care what your mum, your dad, your uncle, anybody is telling you. Trust me, a pension is definitely worth it. If you can get to the point where you start to have into a pension 10% of what you earn every single year from now until, I don't know, the next 25 years, believe me, it's going to be life changing. It is going to give you options when you get to that stage of life. Trust me, it is so, so worth it. My advice to you, if I was 24 again, I would basically be telling myself that, try to make sure, especially with the social media age, that you don't buy into these, all of the stuff that you're seeing on social media about Rolexes, you've got to drive a nice car. Be very, very stringent and structured with your finances. Yeah. Just get into the habit of, right, I've got this coming in, this much going out. Try to limit as much as you can going out, not to the point where it's going to be restricted, where you can't go out with your mates and go on holidays and do the things that you want to do. You obviously want to be doing those things. But please, no matter what it is, even if it's £10, £20, £50, £100 a month, try and put that into an investment of some kind and just forget it. Literally set up a standing order or a direct debit, have it go there every single month. You will notice it the first maybe 1, 2, 3, 4 times it goes out. After the fourth, fifth time, trust me, you won't even miss it. It will just be money that is going somewhere, and that will build up quite nicely. The power of compound interest for you is absolutely huge, but simple, small habits make a very, very big difference. The issue is, and again, this is something maybe try not to buy into, is this whole idea of short-termism. You've got to have it right now. If you've got friends who are like that, that's fine, but try to have a long-term view with all of it. Trust me, you will thank yourself 20 years from now. And I know that you'll be thinking 20 years is a long, long, long way away. Believe me, you'll be there just like that. It will fly by so quickly, and you will thank yourself for doing something so early on that has given you dividends in 20 years' time. So be structured with your finance. Don't overextend yourself. Don't go and buy stuff if you don't absolutely need it, especially if you're buying something on finance. Literally, debt is the killer of dreams. If you get into a lot of debt, and I had a lot of debt when I was younger, trust me, it's a drain on your income. In most cases, it can really affect you from a mental health point of view and just from an overall well-being point of view. It gives you a very, very different kind of outlook on life when you're looking at your bank balance and you know you earn money. If you can, try not to get into debt at all. Structure your finances and invest a portion of your earnings every single month, and make sure that you're paying in the minimums into your pension at the very, very least. That will be my advice to myself at 24 years old. GT Playboy saying this book is a good one. I've not heard of this one, so that might be one I put on the list as well. Okay, this is a good one on the mortgage. I should have added: is it sensible or viable to get a slightly larger mortgage in order to go, um, in order to okay, what I'm going to say a slightly larger mortgage in order to and beat the interest in the market? Mate, you'll have to explain that to me. That last bit doesn't make any sense. I'm just trying to figure out what you might actually mean. Slightly larger mortgage to beat the interest in the market. Okay. Are you trying to basically say go for a higher mortgage? Oh, no, no, it doesn't make sense. Can you just clarify that for me, mate? Let me just go down quickly and just see if you've added anything else onto this. Shit, there's a lot of questions on here. We might not be able to get to them all, mate. Sorry. Okay. Yeah, sorry. That one, I don't know what the last bit of that question means, so I can't answer. Where was I? Where am I? There we are. Okay, cool. Uh, Manuel, we've already done this one. One second. Where am I? Okay, here we go. So we're not saying in half research license more. I didn't know about the magic free government money thing. Yeah, mate, trust me, it's awesome. It's really, really good, and it's help people get on the property ladder. So that 25% return is a return of its own. So that is your primary bonus. Anything you get in market returns is just an additional piece on top of that. So don't try and overextend yourself. Don't try and be a little bit too over enthusiastic, because that 25% return is pretty decent. I know it's only on 4K, and 4K is still a lot of money for a lot of people, but it is there to help. Okay, there's a conversation about Web 3.0 there. Cheers, dude. Really appreciate it. Okay, cool. There's a question here from 0161. Okay, would you say that with the rate hikes this year and the negative outlook for stock market in general, now would be a good time for someone to liquidate their portfolio and put a large deposit on a property? Um, Liquidate your portfolio. If you're at a loss, then no, because you don't want to cash in a loss. I mean, you've got to understand that property is not a sure thing. Like, property market still has fluctuations, and property is a lot less liquid than stock market investments. Plus, you don't have as many tax benefits in property as you do in the stock market. And this is very much kind of like a personal outlook. You really have to think about it. So if you go from the stock market, where you've got ISAs, you've got all of these tax efficiencies, you can cash in your stocks at any given time, get it out. If you go into property, then it's rental income, getting a tenant, management fees, all that kind of stuff. You got to think about where you're buying, location, right? Rental yields. Based on your location, how much is the property like to increase in value? If you did want to sell that property as an investment property, capital gains tax. On top of that, then you need to think about how long it's going to take you to actually sell that property. God forbid you need that money very, very quickly, right? So you've got to think about all of these things, the cost of selling the property. Property is a good thing to have, and as an overarching piece of your investment portfolio or your asset base from a net worth point of view, property should definitely be in there. But what I say, just because we are looking at a negative outlook for the stock market, that you should just take your money from the stock market, go into property. No, not just on a pure, this isn't good anymore, it's going through a volatile period, over to here. Because God forbid, the property market also goes into a volatile state, whilst the stock market is in a volatile state. We've seen this before, 2007, 2008. People end up with negative equity in their mortgages, their stock's down. What do you do then? You've now traded one where you're going to have to wait for the property prices to increase, which typically could take longer than stocks to do so. So you need to have a really, really good look at it before you decide on what to do. And just bear in mind that there are so many other tax advantages within investments that you don't get within property specifically. But that isn't an absolute don't do property. You've got to weigh both of them up on merit. I think you just put a thing on the end there. If that person eventually needs to buy a property to live in for the long term, I think if you're going to buy a property, you need to know whether you're going to live in it or rent it from the get go. The reason for that is if you're buying a buy to let, your deposit amount is completely different to if you're doing a residential mortgage. And then the help you're going to get as a residential mortgage participant is you won't get any help on the buy to let side to things, none whatsoever. So ideally, you know whether you're going to live in it or rent it out to start with. That would be the first question you need to answer before you even start looking at property, because your starting point will be different on both of them, and you'll have to prepare accordingly based on that, whatever approach you decide to take. Okay, this is let's have a look at this one. What up, Pete? My question is, what percentage of your portfolio or monthly investment should be allocated to high risk, medium risk, low risk, long term investing? Mind 20 to 30 years plus. Amazing. Right. Okay. Cool. Let's have a look at this. All right. Okay. So I'm just going to recap what I kind of explained a little bit earlier on, just for anyone who wasn't here and didn't get the crux of what I was talking about. 1 second, I've just got rid of my window. Let's share this one. Okay, cool. So I said earlier, if you're looking at your timeline, so this is how long you're looking to invest for. Yeah. If you go in here, the longer you have, the more risk you can afford to take on. So the longer, the more. The less time you have, the less risk, or the shorter your term, the less risk you should be taking. At 20 to 30 years, you can afford to take a lot of risk, because ultimately it doesn't matter whether you see the markets do this, yeah, as long as you've got enough time to ride out the markets between the dip and the end of your investment term, yeah, it doesn't matter. You can ride out the market waves, the market volatility, so you can afford to take more risk. Now, typically speaking, if you are, and bearing in mind you're asking low, mid, high risk, low risk basically indicates you have less time. Yeah. So if you are less time, and I'll give you this answer based on what we used to do as professional investors in discretionary fund managers. Yeah. So if we're building an investment portfolio, right, and this is low risk, you would probably be looking at equity exposure maybe at around, I don't know, 20 to 30%. is what you'll be looking at on low. Now, many people will be like, oh my God, Pete, that's just rubbish. What does the rest of it comprise of? Well, the rest of it, all of this here, we would normally put this in things like bonds, typically. Because with a bond, you have a coupon. So with a bond, you can gauge what your return is going to be depending on how you access those bonds. But that's typically what we'll be looking at on low risk. And again, that's bearing in mind you've got a shorter period of time. Now, if you're looking at medium risk here, medium risk, then what you might find is on the equity side, you could be anywhere between 40 and maybe 50%. Depending. Now, there's a whole nother level of conversation we can have here around when you're investing, they will have like parameters to be able to flex either side. So they could go 60 up here. They could go all the way down to 30, depending on market conditions. So there's that flex depending on what approach you go for. But typically speaking, if you're looking at medium term, you're looking maybe 40 to 50% in equities. Then the rest of it, again, will be in bonds. If you're looking at long term, then typically you might be looking at, say, something like 70, 80, maybe even 90% going into equities. Then the rest will basically go into bonds. Again, depending on how you invest and who you're basically using, especially if you're using a managed fund or managed portfolio or managed provider, they can flex and go higher. Now, let me just tell you this, by the way, guys, because, in all of my time, I have rarely seen a 100% equity portfolio unless it was being managed by a discretionary fund manager with a mandate to go 100% equity. And in order for traditional investment managers, discretionary fund managers to go 100% equity, they would generally ask that the person has a very, very, very decent amount in terms of emergency funds, and they have to be experienced in the investment side of things, which is why sometimes I stress to people that the ETFs in Vanguard, they are 100% equity. From a professional investor's point of view, it is very, very rare. I've only seen 100% equity mandates under a professional manager a handful of times in all of my time working in the investment side of the world. And that is oftentimes with a 100% equity allocation. They are mandated to stock pick specifically for them. So this will be clients who have a very specific interest in something very, very specific. And there is a tailored, calculated, researched approach towards the stocks that go into that 100% mandate. So new age investing tells us 100% equity, just go in, which is fine, but you need to kind of expect what you're doing. 100% equity is 100% equity. You don't have that counterbalance in any way, shape, or form using bonds, using any of the other asset classes. I mean, I talk about the rest of it might be bonds. Mixed in with bonds, you might have some property funds within there as well. You might actually have some commodity exposure, so oil, gold, you might have within there as well. So in that bond section that I illustrated, let me just bring this up again. That I illustrated here, yeah, this area, this might also include things like property and gold, right? There's a mixture of other asset classes that they will also use within this as well. But bonds generally tend to take the biggest weighting within that section because of the security that bonds can provide within an investment proposition. I explained a little bit of that on the live that I did. I think it was on Wednesday, where I talked about it's a balancing act. Everything is a balancing act. Nobody wants to be overexposed to a risk. It's all about managing your risk. You start with that basis to start off with, that in conjunction with your goal. All right, so let me just find this. I'm just conscious of time. We're now 15 minutes in, so I think I will take maybe one more, and then we'll pick up again maybe next week with some other questions. Okay, let's have a look at this one. Not sure whether to go with Vanguard or FreeTrade. Is the question here for an ISA? Am I right in saying Vanguard has more fees like per transaction, whereas FreeTrade has a £3 a month plus the currency conversion fee? So within Vanguard, you are going to pay for the ETF costs, and then you'll pay for any transaction fees on top. Typically, there will be either entry or actually some of them, most of them don't have entry and exit fees. Actually, to be fair, without doing a direct comparison, I wouldn't be able to tell you specifically. But essentially, with free trade, you're going to pay £3 a month for the benefit of their ISA. Um, if you're not part of the premium side to free trade, you won't have access to the full ETF range, which is fine. What else will happen with with free trade? I mean, look, the stuff that they have in as part of the free element to it, I think will be enough for you anyway, because you'll find some pretty good things in there, assuming you know what you're going to be investing in. But I think it's really important to just have the distinction between what Vanguard do and free trade do, because they don't do the same thing. Like you can't buy individual stocks in Vanguard. So if that's what you're looking to do in trading 212 in free trade, sorry, then free trade is definitely the one for you to go for because you can't do that within Vanguard. Vanguard is an ETF index fund provider. So if you're trying to compare them from index fund provision or ETF provision, well, you're going to pay the same fees in free trade as you would do in Vanguard if you get a Vanguard index fund or ETF in free trade, because essentially those fees have to be paid either way. It doesn't matter where you get it from, you're still buying a Vanguard ETF or index fund. So those fees you're going to pay. In that instance, free trade will be way more expensive because of the extra £3 per month that you're going to be paying. So you'll be paying £36 a year plus the Vanguard fees, plus if they add any kind of like commissions or charges on top for them finding or providing that Vanguard ETF or index fund to you. Some people do that. Hargreaves Lansdown does that sometimes as well. So if you're looking to buy ETFs and index funds specifically, Vanguard will be cheaper because you can have an ISA with Vanguard without paying the £3 per month. If you want to buy individual stocks, then you can't do that with Vanguard. You'll have to go with free trade. Period. I hope that helps in some way to kind of answer the question. You've said in there currency conversion fees, part of the game, mate. Can't do anything about it. If you're buying something in dollars and you deposit pounds, you've got to do the conversion. That will be true for Vanguard and free trade. So that's just part of doing business, essentially. Maybe compare the costs and the fees explicitly. I think if you go onto the Vanguard site, they do have a segment where they outlay all of their fees. I showed it in a video. Actually, no, it's right here. Actually, bear me 1 second. I'll show you. I need to get rid of this screen just to share the other one. Bear me 1 sec. Okay, so if you go onto the Vanguard homepage, yeah. So you just go home, Vanguard. And if you go all the way down here, view our fees, you'll be able to view all of the fees there, basically. So you can do a direct comparison between Vanguard and free trade. It means you've got to sit down with it and kind of like, go through some paperwork and make sure that you find all the relevant fees, but the fees are all here. And you can see the full cost and charges as well. So if you're going for particular ETFs, you can see exactly what the account fees are, what the total cost is. Always pay attention to the total cost. Don't just pay attention to, the account fees. Pay attention to the total cost. But you can see everything here. Most of them do not have exit fees or anything like that. And that's a good thing. So just do the do the comparison there, and hopefully you'll be able to discern which one is actually going to be cheaper. I'll be surprised if Vanguard is more expensive than free trade, though, if I'm completely honest. All right, okay, cool, guys. Appreciate you for being here. Look, I'm going to be doing this every Sunday this year. That is the plan anyway. I'm supposed to be working on a few projects, and we're supposed to start shooting next week, but I think that's being pushed back a little bit. So it might be a case that on some occasions or some Wednesdays, I won't be able to do this, but I'm going to try and keep this up every single week. What I will ask is, if you find value in this kind of in these kind of sessions, your help is really, really needed in terms of, tell people about it. If you know people who have questions about mortgages, that kind of stuff, get them to tune in on a Sunday. What I would really, really love to see is the number of people dialing in on a weekly basis, kind of like growing. I know during the height of the pandemic, I would do these and we'd have like 200 people on here. I think the max I've had is like 250 or so, which is amazing. I want to kind of get back to those levels and exceed those levels. I know it's a Sunday evening. Maybe we need to tweak the time a little bit so it's more accessible for people. I'll be open to your feedback for that. But the idea is, if I'm going to spend my time trying to answer as many people's questions and try and share my knowledge and my experience, I want to be able to do that to the biggest number of people possible. So please do share. Please do like the video as well. That really, really does help with the YouTube algorithm and just letting people know that we're doing this stuff. As far as I'm aware, I'm the only one on YouTube doing this in the UK space. There isn't anyone else doing this on the UK space where you can actually ask questions who's actually qualified as a financial advisor, qualified as a mortgage advisor. There isn't anybody. And as I look at the channel this year, trying to kind of like push the channel further and try to kind of help more people and maybe build more trust with what I'm trying to do here, your help is really, really needed, just so that it feels as though we're making progress in actually helping people and touching people's lives. So I'd appreciate your support on that. Thank you so much for spending this time with me on a Sunday evening. I know most of you will have work in the morning. I have a very, very early start, so I'm going to pretty much just chill out for the rest of the evening and try and wind down. Thank you so much, guys. We have a video. Oh, by the way, Tuesday. So many people have been asking me questions about tax on crypto. On Tuesday, I am with an accountant that is going to answer. We have a we had a great in-depth discussion around crypto and tax, what HMRC is thinking, how they view crypto assets and cryptocurrency, the powers that they basically have. We had a look at some scenarios around, can offshore tax havens moving away actually help you if you're looking at investing in crypto. We have a look at capital gains tax considerations there, when income tax becomes an issue if you're staking, minting. Really, really big area there. Really, really big area. We talk about a lot of stuff. And the accountant, Chris, is also scheduled to be on a live Q&A with me in maybe 2 or 3 weeks. We need to just get something in the diary. So please pay attention to that video and share that video tomorrow. It is long form. It is an hour and a bit long. We talk about a lot, but it is jam-packed with a lot of really useful information from a qualified chartered accountant. He's actually a partner in RSM, which is a worldwide accountancy firm. He's very, very knowledgeable. He writes about crypto and taxes for a lot of the national tabloids in the country as well. So he's a great resource. That video is out on Tuesday. It's also a podcast which will be out tomorrow morning. So if you listen to the podcast, you want to see the visual to it, you can come along on Tuesday to watch that. But if you could share that, that will be amazing. I know that attention spans are generally quite short on YouTube, but we really do talk about some very, very important stuff when it comes to tax and crypto specifically. So I'd appreciate your support with that. And if you haven't already, subscribe to my magazine. I've got a new monthly magazine. Go onto my website, conversationofmoney.com. There is the cover of issue 1 there. Go and subscribe to it. The next issue is going to be out in maybe 3.5 weeks' time. We'll be covering investing, crypto, personal finance, all things news, all that kind of stuff in very simple language. And within that, every single month, we're also going to be improving your financial vocabulary. So what do all of these terms mean when you're coming across, asset allocation? What does that mean? Right? Total return is what we covered in issue 1. What does that actually mean? We'll be improving your financial vocabulary every single month as well. So if you haven't subscribed already, go and subscribe to that. That will be really, really great. I'm actually thinking of doing maybe like a little bit of a referral program where I can actually start to reward people who share the magazine and get people to join as well. But anyway, there it is. Whatever you do this evening, for the rest of this evening, have an amazing time. And yeah, thanks for joining me. And I will see you on Tuesday.